Hey guys, it's Julie here with TipRanks, and today we're taking a look at some big name tech stocks that have been dipping in price. So let's get into it. All right, welcome back everyone. Thank you all so much for being here. Today we're taking a look at three huge names in the tech sector that have been trading in the red recently, but still come in with a strong buy consensus from Wall Street analysts. We're going to take a look at these companies, what has their stock down lately, and what those Wall Street analysts are predicting for the stock's future. You can follow along over on the TipRanks website or on the TipRanks mobile app. Links to download will be in the description down below. Just before we get into our big tech stocks, this is a reminder that if you enjoy today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Let's dive right into our three strong buy tech stocks. First on the list today is Uber. They trade under the ticker UBER, currently priced above $68 per share. Now year to date, the stock is in the green, up over 11%, but from highs back in October, they're now down over 20%. Uber shares have been under pressure lately as competition in the robo-taxi arena heats up. Google's self-driving unit, Waymo, recently closed a big deal, recently announcing that they closed an oversubscribed investment round of $5.6 billion, saying that with this latest investment, they'll continue to welcome more riders into their Waymo One ride-hailing service in San Francisco, Phoenix, and Los Angeles, and in Austin and Atlanta through our expanded partnership with Uber. They'll also continue advancing the Waymo Driver, their AI-powered autonomous driving system, to support a variety of business applications over time. Now, you might be thinking, if they're partnering up with Uber, then why was this a negative impact on the stock? But they're saying that it raised investor concerns over Uber's reliance on other companies for their autonomous technology, which could possibly impact their profitability in the future. On the other robotaxi front, we have competition growing from Tesla. Now, Tesla is still years away from launching their robo-taxis, but with the new upcoming Trump administration, it is said that regulations surrounding autonomous driving are expected to change, as it's anticipated that the Trump administration could accelerate autonomous driving regulations. Uber has also been falling since their Q3 earnings report on October 31st, dropping about 13% since then, despite a Q3 earnings and revenue beat, as the company's future guidance was underwhelming. Uber reported Q3 earnings per share of $1.20, beating analyst expectations by 82 cents per share. Revenue grew over 20% year over year to $11.2 billion, and their gross bookings did grow 16% year over year, but did just miss the consensus estimates. For their fourth quarter outlook, they're anticipating gross bookings of $42.75 to $44.25 billion, with that midpoint falling a bit short of analyst expectations. But even with all this, Wall Street analysts still rate the stock a buy. Just today, we heard from a 5-star analyst at Jefferies who said that the recent weakness makes for an attractive entry point. They noted key drivers of concern, including Waymo's share gains in San Francisco and Tesla's bold ambitions, but believe that the recent weakness does create a more attractive entry point, and that their analysis shows the near-term impact to rideshare will be minimal, and their view remains that robotaxi fleets are best off partnering with rideshare. And recently, an analyst from RBC Capital increased their price target. They said a combo of a slight mobility miss and a provocative autonomous vehicle discussion may have spurred some knee-jerk selling, but this is obviously an opportunity, with growth rates across the business remaining healthy above 20% and the company's new verticals continuing to grow fast. With 34 analysts weighing in on the Uber stock, it does come in as a strong buy, with 32 buy ratings and 2 holds. And the average price target of $91.86 would imply an upside potential of 33%. Looking at some of those recent ratings down below, our high-end price target does come in from Evercore at $120, which would imply an upside potential of 75% from current prices. On the lower end comes in at $82, which would still be an upside of over 19%. Second on our list today is Microsoft. Trading under the ticker MSFT, they're currently priced at $415 per share, and year-to-date they are in the green, up 11%, but more recently trading in the red. From highs here back in July, the stock is down over 11%. The Microsoft stock has been under pressure amid investigations by U.S. regulators, as the Financial Times reported that the FTC is planning to launch a probe into Microsoft's cloud computing business and examine allegations that Microsoft is abusing its market power in productivity software by imposing punitive licensing terms to prevent customers from moving their data. Of course, this is not Microsoft's only brush with the FTC. Back in the summer, the FTC was also investigating their $650 million deal with Inflection AI, probing whether Microsoft willfully structured its transaction with the AI startup in a way that avoids government antitrust review. On top of this, there has been growing concern in slowing demand for their Azure cloud services and when Microsoft will start seeing some serious profitability from their AI services. To stay competitive in AI development, Microsoft has been making significant investments, which could put pressure on their profit margins in the short term. And in their recent quarter, they also cited potential delays in data center infrastructure needed for AI services. Speaking of that recent quarterly report, that came out at the end of October, and they did report both an earnings and revenue beat. For their Q1, they reported earnings per share of $3.30, which did come in 20 cents better than analysts were anticipating. Revenue came in at $65.6 billion, beating by over $1 billion and growing 16% year over year. However, looking forward, the company is now anticipating Azure revenue growth to be 31 to 32%, which was down from 34% last quarter. Following that earnings report, we did hear from an analyst at Evercore who said that the pullback is a buying opportunity. They noted that Microsoft reported solid Q1 results that beat expectations across the board. However, shares are under some pressure as the Azure consumption growth was more in line with expectations, while the growth guidance came in a bit lower than expected. That lower than expected guidance was partially due to some AI capacity being pushed out for the second half, given that the company reiterated its call for Azure to accelerate in the back half. The firm sees weakness in the shares being a buying opportunity, given that their AI offerings are on track to reach a $10 billion run rate in Q2. We also saw an analyst from JP Morgan reiterate their buy rating but slightly lower their price target. The JP Morgan analyst said that the firm has no issues with the Q1 results, but Microsoft is guiding below, and this caused the after-hours sell-off in shares. By far the greatest magnitude of the guide below lies within more personal computing, but the firm views MPC as less important to Microsoft's fundamental thesis as compared to the higher margin, stickier annuity streams, and therefore this is less concern, though they did add that the developments do pose unhelpful near-term hurdles nonetheless. With 29 current analyst ratings, Microsoft does come in as a strong buy with 26 buy ratings and 3 holds. And the average price target of $495 implies an upside potential of 19%. Looking at those more recent ratings here, on the low end we do have a hold at $425 for a slight upside of 2%, while our high-end price target would be $550 from Jefferies for an upside of over 32%. If you've made it all the way to our third stock today, then this is a reminder to make sure you hit that thumbs up button. Last but not least, we're looking at Advanced Micro Devices. They trade under the ticker AMD, currently priced at $138 per share. Year to date, the stock is down about 6%, and from highs back here in the summer has actually dropped nearly 25%. The AMD stock did go on a tear within the past year, hitting highs of over $210, but has been cooling off lately and lagging competitors like Nvidia and Intel. Over the summer, AMD did have to delay shipping their Ryzen 9000 chips, saying it was out of an abundance of caution and some quality concerns. And the company recently announced they'd be reducing their workforce by about 4%. Laying off about 1,000 employees as they plan to focus on developing AI chips to better compete with the industry giants like Nvidia. And over this past year, AMD's earnings reports have left a bit to be desired. Most recently, in their third quarter, their earnings and future guidance fell short of Wall Street's expectations. For their third quarter, they reported earnings per share of 92 cents, which was just in line with analysts' expectations, while revenue did come in at $6.8 billion, which grew 17% year over year, beating by $110 million. They noted strength in the company's data center segment, which rose a record 122% year over year to $3.5 billion thanks to their AI processors. Looking forward, they're anticipating revenue between $7.2 and $7.8 billion, with that midpoint falling slightly below analyst expectations. Following that quarterly report, we did hear from an analyst at UBS. They said that AMD guided revenue in line with where the firm expected, though now that segments beyond data center are no longer headwinds, some investors may be slightly disappointed, but UBS thinks the story is on track here. In the near term, the stock may stay a bit range-bound, and they worry that 2025 could be more of a transition year for the AI story. A 5-star analyst from Phillips Securities also reiterated their buy rating, saying that AMD has been successful in increasing its server CPU market share against Intel and that their performance in the PC market has been strong. They said that AMD does face challenges in its gaming and embedded segments, which have shown weaker performance, but despite these challenges, their overall position remains favorable due to their strategic advancements in AI and PC markets. AMD is currently rated a strong buy based on 33 current analyst ratings, breaking down to 26 buys and 7 holds, with an average price target of $187, implying an upside potential of 35% from current prices. Looking at some of those recent ratings down below, on the low end we do have a hold rating here with an upside of about 12%, while our high-end price target comes in at $220 for an upside of nearly 60%. So that is a quick look at 3 tech giants that have all been dipping in price lately, but Wall Street maintains a strong buy consensus on. Let me know your thoughts on these companies in the comments down below and which one catches your eye most at these prices. I always love hearing from you guys. Please keep in mind these videos are never a suggestion to buy or sell any specific stock, so make sure you always stick to your own investment plan. Thank you guys so much for watching. Have a great day, and I'll see you back here next time.